The housing market is red hot. Existing home sales are down because inventories are at record low levels, not seen in a long time. There are only about 1 million homes on the market, and at this current pace, we could rip through those in about 2 months. So I know a lot of people are talking about the housing market crash and the upcoming crash in housing because of the forbearance and people behind on rents and things like that. And there's only maybe at the end of the day a net 1 million houses. If everything happened and all of the people in forbearance gave up their homes and the properties were foreclosed on, or they gave them back to the bank, or whatever the case, that would only add maybe another 1 million homes back to the market, which would bring the inventory right now up to 2 million. Let's just say it happened today. You go from 1 million to 2 million. Well, now you go from 2 to 3 months worth of inventory to 3 to 6 months worth of inventory. So again, that's not something that's going to put a dent in the housing market. What will and what can tank the housing market is what tanked it the last time: interest rates. So the key is interest rates. It's not forbearance. It's not anything like that. The bottom line is interest rates. A lot of the forbearance is strategic. There's a lot of people that are just taking a payment vacation and holiday, and then they're going to turn around and see if they can work that loan out and get a loan modification. Forbearance is not a modification. It's just a break from the payments. There's still going to be, those payments will have to be made up at the back end of the forbearance program. So the lenders are incentivized to work with the borrowers to put that balance on the back of the loan and do a loan modification. So a lot of those houses won't even come back on the market. So I know a lot of people are putting statistics out there about how many people are in forbearance and this, that, and the other thing. And again, there's only 1 million homes on the market right now. That the sales pace and the current demand, that can be worked through in about 60 days. So if we had another 1 million, 2 million houses hit the market, they would just be worked through. It would just take a little bit more time to work through that inventory. So that is not the catalyst to tank the housing market. Interest rates is what will tank the housing market. As rates go up, values go down because people, the affordability index goes down in terms of the interest rate. So the lower the interest rates, the more people can pay because their payments stay lower. Remember, people are buying payments. They're not buying the price. They're buying that monthly payment. It's all debt to income. So the lower the payment, the more they can afford. If the rates go up, the higher the payment, the less they can afford. So the price of the house comes down. And you can do the math. For every 1% that the interest rates go up, that will affect the values of housing somewhere between 10% plus or minus. So you want to do the math and you want to look at that and work that out. But what tanked the market in 08 and 09 was really the subprime loans that were being given to unqualified borrowers, not only owner occupants, but investors. So that's what created the toxic assets that were on the books of the bank. But what triggered that bomb were interest rates. If interest rates had remained low and the banks worked out that debt with borrowers, we would have never seen what happened in 2008 and 9. The problem was the banks were just foreclosing. They weren't working things out. Interest rates were going up. So people were just bailing on those properties and just giving them back to the banks because a lot of them were strategic defaults where people just handed the keys over, didn't make payments, stayed in the house as long as they could. Some of that's going on in the forbearance market. But the difference is this time the banks are on board. They're going to work with borrowers. They do not want those bad loans on their books. And the government is on board with propping up the housing market, the mortgage industry, and the commercial markets as well. So watch the interest rates. That's the key. That's what will affect values in the housing market. It's not the forbearance. Those numbers are not big enough to make a big impact or a dent with the current demand in the market right now.